with the average rent prices increasing 8.85% per year since 1980, consistently outpacing wage inflation by a significant margin. And just to give you a visual, look at the historical median monthly rents year over year over the past 70 to 80 years. And with inflation skyrocketing and everything becoming more and more expensive, one of the biggest things long-term investors like myself should be focusing on is how they are going to generate more and more cash flow over time from investments as time goes on. Now, this is very important and maybe the only fighting chance we have to fight back against how expensive life has become, and most likely how expensive it's going to be in the future, unless you for whatever reason think that things are going to get much cheaper from here, which I doubt a lot of you do. Now, in this video, we're going to be breaking down which metric I think is very, very important that a lot of long-term investors might be overlooking, but should be focusing on particularly when it comes to investing. Then we're also going to be going over a perfect investment vehicle that is not only going to keep up with inflation, but could even surpass it in the future. Now stick around, drop a like down below, and let's get right into it. I just finished my brand new dividend investing ebook where I share exactly how I went from zero to now over 7 figures invested, and also on how I earned more than $6,000 per month in dividends. I also finished my custom dividend tracker that you can use to track your dividend income progress on an ongoing basis. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now first, before we dig a little bit deeper into this metric and of course which ETF can offer a fighting chance against inflation and all other future expenses increasing over time, let's look into the United States inflation rate. Now if we look at the inflation rate on the 10-year time frame, we can see very specifically that of course over the last few years inflation has absolutely skyrocketed, but even before then inflation has consistently been going up more or less over the last 5 to 10 years. Now, a lot of investors, including myself, don't think that things are going to get much cheaper anytime soon, and in my opinion, things are probably only going to get more expensive as time goes on, but we can of course discuss that in a different video. But regardless, even if inflation was to stay at let's say 2 or 3% on a yearly basis, that's still going to be a significant increase in expenses when you extrapolate out 10 or 20 or 30 years from now. So again, this is more geared towards younger investors that have a long time frame ahead of them. Not to mention things like median sales prices for houses across the board. Looking at how much the average house has cost over time is also a very clear indication that inflation is here and that things most likely are going to keep getting more and more expensive. Once again, unless you think for whatever reason that house prices are going to get chopped in half, which of course is possible, but in my opinion, not very realistic. Now the metric I'm talking about is DGR, or dividend growth rate. So dividend growth rate is a measure that indicates the annual rate at which a company's dividend payments have increased over a specific period of time. It represents the compounded annual growth rate, or CAGR, C-A-G-R, of dividends over that period. And the dividend growth rate is often expressed as a percentage. Now, if you were to calculate the dividend growth rate, you would typically take the difference between the final dividend payment and the initial dividend payment, divide it by the initial dividend payment, and then divide that result by the number of years in the period. And finally, the result is expressed as a percentage. So a real quick example of this would be, let's say a company paid a dividend of $2 per share in the first year and then increased it to $2.50 per share in the 5th year. The dividend growth rate over a 5-year period would be calculated as follows. It would be the final dividend minus the initial dividend, divided by initial dividend, divided by number of years, which would give us in that circumstance a 5% dividend growth rate. Now, dividend growth is especially important for investors that might not have all that much money, all that much capital to invest into an ETF like this. Now, this is simply because in theory, what this means is that if an investor was to invest into something like SCHD today, if SCHD ETF's dividend growth rate continues like it has in the past, that investor will be getting paid more and more money for every single share of SCHD that they own. And it's probably not even worth explaining why that's an important metric, because as we just saw a second ago, all the different inflation data shows very clearly that either your income or your investment income needs to stay on pace and keep moving up over time. And a best case scenario would be both your income and investment income, of course. And although of course there's many different options to invest into that do offer a nice healthy dividend growth rate, one of my favorite ETFs, one of the largest ETFs across my portfolio, is the Schwab US Dividend Equity ETF, which does offer a massive dividend growth rate, which we're going to go through here in a second. Now, real quick, if you're not aware, the SCHD ETF or the Schwab US Dividend Equity ETF offers a very cheap expense ratio of just 0.06%, which means over time the fund's expense isn't going to eat up too much of your profits. Now, also important, this fund tracks as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index, which is a very impressive index which has a lot of screenings for stocks to get in and out of, which makes the overall list of holdings pretty impressive. But to get right down into it, because we're really focusing on the dividend growth rate that an ETF like the SCHD ETF has, and how this can not only keep up with, but even surpass the inflation rate that we could possibly see long into the future. Once again, this is just assuming that things are going to continue to get more and more expensive, which happens to be my point of view. Now, to get to some of the more important aspects, at least pertaining to today's video, SCHD currently has a 3.45% trailing 12-month dividend yield, so investors buying into SCHD can expect about that ongoingly. But like I mentioned towards the beginning of the video, this is a perfect ETF for an investor to say, invest a small amount of money in over a long time period. Because on one hand, this ETF does have the tendency to raise in ETF price over time, at least it's went up historically, but also as you can see right here, every quarterly dividend for the most part over the long term has continued to go up and up and up and up, going to pay you a specific amount in dividends, but then next year, the year after that, and ongoingly, it should be paying you more and more over time as long as the dividend growth rate and as long as history was to be able to repeat itself. Now, even if you were to downplay the dividend growth rate that SCHD has had so far, even if you were to say the dividends paid by SCHD are going to be moving forward, let's say 5 to 7 to 8% on a yearly basis, that means that on a yearly basis, you are going to get a raise in the form of quarterly paid dividends of say 6, 7, or 8% every single year ongoingly, which is going to easily keep up with the rate of inflation if inflation stays around say 2 or 4% on a yearly basis. Now, this is exactly one of the main reasons on why I use SCHD as a main foundation for my overall long-term portfolio. I'm currently 31 years old and I've been buying shares of SCHD consistently over the last few years, and I'm going to continue to load up on shares, not only of course because of the healthy dividend growth rate and the fact that I want to have an investment that's going to continue to pay more and more to not only keep up with the beat inflation, but also of course the fact that SCHD does have some massive growth potential as far as ETF price, and also important to mention the fact that SCHD has a good screening process for different holdings to become a part of the index. But like I said a second ago, it's not only SCHD that has a great healthy dividend growth rate. Looking at something like the Vanguard Dividend Appreciation Index, or ticker symbol VIG, this is another one of my favorite long-term buy and hold ETFs that has a considerably high dividend growth rate. Used, for example, back in 2013, VIG was paying 40 cents per share per quarter, and now just as of recently, almost 80 cents per share per quarter in dividends, which means the dividend was almost doubled over the last 10 years, which is very, very impressive. And to be completely honest, there's lots of different investments that can keep up or surpass the rate of inflation, but I think that dividend growth rate is an important metric for a long-term investor to not only keep an eye on, but also to really utilize for their overall strategy when it comes to investing long-term, because I would hate for this chart right here, the United States inflation rate chart, to be outperforming your overall growth in your investments long-term, because at that point, you're pretty much just spinning the wheels. But when it comes to holding on to a long-term buy and hold ETF that you think is going to surpass the United States inflation rate long-term, comment down below some of the ticker symbols in the comments and let us know which one's your favorite and why. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.